Hey everyone, welcome back. In today's YouTube video, we're diving into a stock that is sitting on $1.82 billion in cash. But here's the twist, it's showing a minus $530 million in free cash flow. We're going to analyze the industry, revenue, free cash flow, debt, and technical analysis. We'll also be discussing some significant financial updates. CPI inflation is hotter than expected.
So
Apple
here's the
faced
case they
several
laid out in the
downgrades
note today.
recently, and Microsoft has now claimed the title of the world's most valuable company. Additionally, the fashion industry is currently at a 52-week low, impacting major stocks like LVMH and Kering. Stay tuned as we take a brief look at this. Let's begin. First of all, the macroeconomic context is bad for this company. Inflation is high, and in the last report for December 2023, we see how the inflation increased a little. But during this time, investors are greedy, almost extremely greedy, according to CNN Business. Inflation prompted central banks to raise interest rates to control rising prices. Higher interest rates can make borrowing more expensive for companies, affecting their capital expenditures, including investments in solar projects, which has a negative impact on solar stocks. In the past year, the company had a performance of minus 9.6%, which is not great. However, it's worth noting that today the stock is down, but it could potentially increase by 10% tomorrow due to its volatility. Additionally, there's the issue of China, which can produce goods much cheaper than the US or other countries. In terms of solar panels, Chinese companies dominate in producing polysilicon and the technology to create wafer panels. Founded in 1999, First Solar is a leading American solar technology company and global provider of responsibly produced eco-efficient solar modules advancing the fight against climate change. The company is unique among the world's 10 largest solar manufacturers for being the only US headquartered company and not manufacturing in China. First Solar's advanced thin film photovoltaic modules represent the next generation of solar technologies. We can notice that the degradation is only 0.3% lower than the alternatives of 0.45% and 0.55% of the conventional crystalline silicon. That makes First Solar a great player in solar industry because they can provide competitive, high performance, lower carbon alternatives. This is a great mode. Their product is unique and better than the competitors, which always is a great sign. But how they make money? Analysts project a 65% year over year EPS growth for this company by December 2024, accompanied by a 4P ratio of only 12.24. Over 92% of revenue is derived from solar modules, with 80% of sales occurring in the United States, followed by Chile at 6.62. The EPS and revenue indicators appear robust in the short term, yet it's crucial to correlate these numbers with industry demand. Now, the big question, is enough demand for their products? First Solar is focused on utility scale projects, while Unphase and SolarEdge are on residential, which are more sensitive. The company's tellurium based semiconductor, which allows it to avoid dependence on Chinese crystalline silicon supply chains, is the second most common photovoltaic technology available today. In the wake of COP28 in Dubai, participants made a resolute appeal for a global shift away from fossil fuels, aiming to attain net zero emissions by 2050. The first solar production facility represents a significant step forward in propelling the world towards cleaner, more sustainable energy, serving as a noteworthy example of the potential for such a transition. As of 2022, about 60% of electricity in the United States came from fossil fuels and 40% came from renewable energy sources. In Q3 2023, the US solar market installed 6.5 gigawatts of capacity, a 35% increase from Q3 2022 and flat growth compared to Q2 2023. This was a record third quarter for the industry, continuing the installation momentum of the last few quarters. We identify four main segments of this industry. The residential, 12% growth over the same quarter last year, Q3 2022. The pricing is up 3% year over year. The commercial solar segment, declining 3% compared to Q3 2022, where the pricing is down 2% year over year. The community solar segment, a 14% increase over Q3 2022 and flat compared to last quarter, and the utility scale segment, 58% growth over Q3 2022. The pricing is up 6%. 58% is remarkable, and this is the sector where First Solar is generating the greatest value. First Solar is a frontrunner in utility scale solar technology. Anticipated growth rates for sales and earnings over the next 3 years are approximately 25% and 60% per year, respectively. Despite these promising figures, the stock is trading at just 13 times the estimated 2024 earnings. The demand is strong with a backlog of 81.8 gigawatts extending through 2030. Also, they have great opportunities with 66 and 32 gigawatts mid to late stage. Is it a good sign that it has negative free cash flow? Well, if we take a look at the investing cash flow, which reflects the cash generated or used in activities related to the acquisition and disposal of long-term assets, we can see it's minus 1.37 billions. Negative investing cash flow typically means that the company is spending more cash on investments in capital assets, such as property, plant, equipment, or other long-term assets that it's receiving from the sale of such assets. Indeed, their allocation of funds exclusively towards property, plant, and equipment substantiates the fact that we are discussing a company in the midst of expansion. Also, notice that the value of capital expenditures is the same with purchase of property, plant, and equipment. They recently revealed a 3.3 gigawatts manufacturing facility located in India. This aligns with the information presented to investors on the official First Solar website, which is a positive sign. The free cash flow is used to buy more equipment to build new facilities to grow. They are very aggressive with the expansion, so you cannot expect a dividend in the near future. They don't pay now dividends, and I think they won't in the next years. Anticipating two additional significant facilities in 2024, one in Alabama and another in Ohio, I anticipate the company will utilize future free cash flow for their construction. It is my hope that they won't incur excessive debt. In terms of debt, the company currently finds itself in a favorable position. The company has $1.82 billion in cash and minus $543 million in debt. Alright, so check this out. The total debt to equity ratio for this company is just 8.62%. That's like saying they owe only about 8.62 cents for every buck they own. So it's kind of like having a pretty low credit card bill compared to the money you've got in the bank. It's a good sign because it means they're not drowning in debt, which is always a plus sign in the business world. What I find appealing about this company is its current ratio, calculated as total current assets divided by total current liabilities. With 3,824 divided by 1,199, it equals 3.19, indicating a remarkably high ratio. One of the most important metrics I look at when evaluating a company is return on invested capital. First Solar has a low one of 5.67%, which I don't like to be honest. I want to see at least 10% for this metric. The return on equity is also low, but a bit higher than ROIC. It is 7.9%. The analyst's average price target for First Solar is $232, which is around 45% higher than the current price of around $160. I think that could be achievable only if there won't be a major economic downturn, but even that the company has a lot of cash and half a billion in debt, which is really great. In fact, it's a management decision to keep a large amount of cash. Just look in the past. We're on the TradingView weekly chart, nothing too super lines at $160, the current price, and $150. Looking at most candlesticks, the weekly price variation averages around 10% from high to low. However, in the last week, this difference is around 5.5%, suggesting a potential further decrease to reach the second support zone. The RSI value is 47, slightly below the midpoint of 50, indicating a declining trend and a tendency to enter the oversold zone. The price has just dropped below the 52-week exponential moving average. This line suggests the formation of an uptrend, but the question remains, will it be sustained? As you can see, there are mixed signals, which is also reflected by the last candle, that is a doji one. When that such candle is formed, the market is in an indecision state. The price has the potential to move in either an upward or downward direction. Operating margins concerns me. Looking at the revenue and operating margins, this company is not predictable, which is a problem to me. The discounted cash flow model is not really that relevant for unpredictable companies. Some tools indicate that the stock is undervalued by 30%, but as I said, that's not really relevant to me because of the unpredictability of the business. My personal opinion is that in the next 2-3 years, we will see a significant increase in demand for solar panels and solar energy, of course, assuming there is no severe recession or any rare event that disrupts everything. Let's assume that inflation begins to decline. In a baseline scenario, First Solar could benefit from increased demand, which would undoubtedly be reflected in the stock price. Given the very low debt level and the substantial cash reserve, the company is likely to weather challenges much better than its competitors. Despite numerous positive aspects related to First Solar, such as its low depth and large cash reserve, the lack of predictability, intensifying competition from Chinese companies, and the negative cash flow makes First Solar a company that may not appeal to everyone and could present both pleasant and unpleasant surprises. Last week, Barclays and Piper Sandler downgraded Apple stock, with Tim Long of Barclays shifting the rating from equal weight to underweight and reducing the price target from $161 to $160. That's not a huge difference, but looking at the current price of around $184, they suggest the stock is undervalued. In a broader context, Redburn Atlantic, Barclays, and Piper Sandler collectively express concerns about potential weaknesses in Apple's iPhone and services segment. They specifically highlight China as a significant worry. Long reports that Barclays' recent assessments reveal increasingly unfavorable iPhone 15 data points from the region, while Comer attributes the concern to China's deteriorating macro environment. Greater China stands as Apple's third largest revenue contributor after North America and Europe. In 2023, this region represented $72 billion of the company's total revenue of $383 billion. That's a significant portion of money. If China will have troubles, I think that all economies will get negative waves. Two major fashion players are in trouble. Kering, the parent company of brands like Gucci and Balenciaga, is currently hovering around the crucial support level of €355. This marks the third instance where the price has approached this support level. Meanwhile, LVMH is also facing challenges. The stock is approaching the €620 support level, but it remains to be seen whether it will indeed touch that point. And that concludes today's episode. Don't forget to give it a thumbs up and subscribe to stay informed with the latest financial analysis. Thank you. Bye bye.